Money Show.
Personal Finance with Warren Ingram.
Time for some personal finance gems now from Warren Ingram. Now, in the movie Forrest Gump, the lead character played by Tom Hanks says life is like a box of chocolate. But Warren Ingram today saying investing is like going to an amusement park. Now, Warren, when I think of an amusement park, I'm thinking scary rides that test your fears, cotton candy, a teddy bear if you're lucky at the end of the day. But what's that got to do with investing?
Well, if you get all the questions right, I'll get you a teddy bear at the end of the show, just to keep you on your toes. So, the thing about going to amusement park and jumping on a roller coaster is you're expecting to kind of get a positive shock and a negative shock. You're expecting your stomach to go up and then gravity to fall away and your stomach goes down again. So you get on the ride knowing that you're on a ride, firstly, and knowing that, you'll get some highs and lows. And you also know that the ride's going to end. It feels like hours, but it takes a few seconds and the ride is over. Now, when you start investing, most of us don't, kind of start our investment journeys thinking, we're looking forward to kind of an emotional, traumatic, journey that's filled with highs and lows and we'll be over in the blink of an eye. What we're expecting is kind of a nice, predictable, chugging along, money's making money, your money makes money babies. And
everything's green.
And life is great, then all of a sudden, the market drops and the falls out from under you and, your stomach drops. And then you kind of realize, hang on, this is not so much fun anymore. This is actually, it is traumatic and it is emotional. And what's worse is we actually don't even know when the ride is going to end. We don't even know that we're kind of at the bottom of the roller coaster cycle here and we can start to turn and go up. So what happens with investing is it's important to understand that you are on a roller coaster and to make things a little bit, I don't want to make it sound frivolous. I mean, obviously investing is about our life's pensions and getting to our financial freedom goals. But you need to realize this roller coaster you're on with thousands of other people in South Africa and then millions of other people around the world. And when you add thousands and millions of people together on the same ride, what happens is those emotions tend to get exaggerated and they tend to get amplified. And so that's what we see now. We see these big cycles where we kind of get huge, flood of news on social media and people kind of, pumping up the hype, whether it's good or bad. And when the markets are down, it's only bad. And all of that adds to our anxiety and our kind of time horizon. When we're looking ahead, we if you're sticking with a roller coaster analogy, you can't even see the end of the roller coaster carriage that you're on. All you can see is the person's head in front of you, and that head is moving, like a crazy thing. And that just adds to the anxiety. So that's where we are now. We're on a roller coaster that we didn't really know we were going to join. And what's happening is it feels like our money is kind of just on this, bottomless pit and never going to recover. And then I guess it's our job on this show to say, hang on, don't jump off this ride, because if you do, you're never going to get back to the top again. And, and guess what? Staying on the ride and not jumping off when most other people will is actually the secret to kind of building your wealth and generating long-term capital growth. And it's about having either the stomach to deal with this huge volatility that we're all living through now, or just the fortitude to kind of stop reading, and stop falling subject to the hype and, switch off your WhatsApp groups and, block those friends who just keep sending you all the articles that tell you that the world's ending tomorrow, and they do it every single day, and somehow the world doesn't end and sun rises again. And that's where we are, is we're in it now. And congratulations if it's your first time. I'm sorry that it's happening to you, but it won't be your last.
Warren,
this is part and parcel of being in the investing world.
I think a great example would have been 2020. If you remember the Davos meetings in 2020, a lot of buoyancy. Everybody's going to invest. There's deals with China and the US, and it's really looking like a great year until COVID hits, which is that slump that you were talking about. And we're already on the ride. We can't get off. Some people are telling you, let's keep going and bet on Bitcoin, but also that tanks. And now we are where we are today, where the lot of market volatility. And in terms of South Africa, everywhere you look around you, there's bad news, bad news, bad news. So what exactly do you need to do from an investment point of view to stay on the ride for as long as you can?
I think it's just starting with, and you used some really powerful words there, bet on Bitcoin. Now, that's exactly what it was. It's just understanding that if you're going to invest, firstly, you kind of have to have an idea of what you're buying. I'm not saying, that you need to become an expert on every asset that you own and, become a stock market guru and a bond market guru, etc. But surely, if you're going to commit your hard-earned long-term capital to something, have a good idea of what it is, and if you're buying shares, and let's just say you buy the stock market index, nothing fancy. At least you have an understanding there that you're buying, some of the biggest companies in SA and some of the biggest companies in the world. And, if the stock market's going south and the economy is struggling, what we know is, that the computers we use, the cars we drive, the electricity when we get it, it powers the TVs that we're watching, the shoes that we buy. All of those things are made by very large companies, and in most instances, those companies will still be around tomorrow and next year and the year after. So buying into something that you understand to some extent is really important, and stop betting. I mean, that's the first point. Stop betting that the world's going to end tomorrow, or stop betting that everything's going to be amazing the day after. The truth is, we have a clue. There is no expert that says with any kind of conviction, look, I know exactly what's going to happen in stock markets in 12 months from now. What we can do is we can say stock markets are cheap. And when they're cheap, the next 5 years is usually very rewarding for investors. And that's exactly what I am saying. I'm not hedging my bets. I'm telling you, buying the Johannesburg Stock Exchange now, with all the bad news, will be a very good long-term investment decision over 5 years. But you shouldn't just put all of your hard-earned savings just in shares, because you need some shock absorbers, in your car, and you need some shock absorbers on the roller coaster. And in the investing world, those shock absorbers are having exposure to things like government bonds, corporate bonds, having some cash, and then making sure that you don't put all your eggs just in the SA basket. So you need to have global investments as well, and equally, the global shares, global bonds, global cash, and having a good spread of investments where you've got some money in SA, some money globally, and then some money across all of those asset classes. That makes sure that, those dips that are going to happen won't be catastrophic for you, because if you've got some money overseas and the rand is imploding as it is at the moment, then what happens is that the rand value of your overseas investments is not too bad. And one day the rand will strengthen again, and then, the JSE will probably be doing well, and then maybe your overseas stuff isn't doing so well. But the secret is to have lots of different kinds of investments that are all moving, at different times. And what happens over time, and that's kind of, again, it's proven that it's the only free lunch in the investing world. It's the only time where 1 + 1 gets you to 2.25, and that is having an exposure to a range of assets all the time, and not stopping and starting. In other words, don't get out of the investment world when things go down, because in all likelihood, when you do that, you're doing it at the same time as all the other people who are prone to panic. And usually what happens is, it's amazing. You can watch this time and time again in market cycles. Everybody panics at pretty much the same time. They all give up pretty much at the same time. And it's usually a week or a month before things turn and really get rewarding. And the problem
Warren,
is jumping. Sorry.
Yeah, I just wanted to say, staying with your amusement park analogy, right? What if I've seen enough of this ride? My stomach's gone out. I can't take any more. The ride stops. I'm allowed to get off. Maybe you want to get into something like shooting water guns at rubber ducks, something more safer and something I can do without having a heart attack. What are some of the asset classes I can look at to get some gains without having too much of a risk?
Well, I mean, we've got two things to talk about there. One, I'm going to tell you can't get off. Unfortunately, it's not a roller coaster ride that ends. It's an investment journey that's multiple years, if not multiple decades long. And please don't get off, but what you can do to make the ride a bit softer, to kind of firm up your stomach and kind of, make you a bit more immune to the ride is add a bit more exposure to cash and to government bonds in your portfolio. But understanding that those those are in some ways, they are diversifiers. If we were driving a car, that's like having brakes and really good shock absorbers. What happens is they help you to kind of avoid a crash, but they do nothing to make the car go faster. In some ways, when it comes to speed, they're just dead weight. And so, the engine of growth is always going to be the stock market and the listed property market around the world. And that's what makes sure that your capital grows faster than the buying power of your money gets destroyed. And remember, that's actually why we do all of this, is we want our money to grow faster than inflation destroys the value of our money. And the only way you do that is to buy the growth assets that give you this heck of a roller coaster ride. And I know it is a roller coaster ride, but you need to be very comfortable that nobody, pretty much everybody in the world needs to have at least a third of their investments in shares. And I would say most of us, most of the time, need about 2/3 to 75%. So 75 out of every 100 rand should be in growth assets. Then the rest you can put into cash and bonds and get a bit of a stabilizer there. But if your temptation is, I'm going to jump off cash, at least I can earn some interest. You're getting some certainty there, which is great. Well done. You've got certainty. What you have also got is certainty that inflation is going to eat the interest that you're earning. In other words, inflation is going to make sure, it's going to guarantee you that the buying power of your money will be worth less next year. So now you've paid for very expensive certainty. You've paid to have a nice kind of stable stomach for the next year, but actually by the end of the year, you're going to be able to afford less than what you can afford today. And that's the real trick with this whole thing, is you cannot afford to let your money go backwards against inflation. You have to take the roller coaster ride.
And there's no running away from it, Warren. If you look at different markets in the EU, it has its own scary rides. The US has its own scary rides. South Africa definitely has 2 or 3 of those. So what do you do at a time like that where, everything is going south and you on this particular ride in terms of your investments? Do you, buckle up more, or do you just stay through the ride all the way through?
You definitely stay in the ride. You do buckle up, but then, and I promise you, I'm not insane and I haven't been drinking. The next thing you do is you try and find some scope in your budget to buy a bit more. Actually, try and get some.
Where's that money coming from?
And you got to make a plan. This is your personal trainer. This isn't the time to tell your personal trainer, I'm tired, I want to go to sleep. Got you. Let me find an opportunity to take advantage of everybody else's fear. Everybody else is afraid. They're selling fantastic assets at really low prices because they are panicking. They're not listening to this show. And it's your opportunity then to say, I can buy companies that are worth normally, let's say 100. And right now, because people are panicking, they're selling them at 50. And I know just by staying staying invested and trying to buy a little bit more, I'm going to get that 50 to 100 journey back again and more, just by being patient, just by having a bit of fortitude, and sometimes just closing your eyes. But please don't bet. I'm not saying to take all your money and buy one share that your friend told you about at dinner last night or that you read about on Twitter. That's a great way to lose money. This is about, buy lots of shares, buy the whole index, buy a whole general equity unit trust, or, a whole bunch of balanced funds or something. Don't take single bets now. Take nicely broadly spread investments across South Africa, across the globe. If you get a bit of scope, you find a bit of money somewhere, you've got a side hustle, whatever it is. This is not the time for excuses. This is the time to say, this is how I build wealth now.
All right, Warren Ingram dropping the gems there on investing even during tough times. Our co-founder of Galileo Capital will pick up this conversation in a moment.
The Money Show.
Personal Finance with Warren Ingram.
Talking personal finance now with Warren Ingram. He's saying today investing is like going through an amusement park, going through those roller coasters, really keeping your stomach during bad times and making sure that you go through it, and having the right mix of assets is what we were talking about before the break. We've got a listener's question now, Warren, on they saying, I have some cash available that I would like to invest offshore. I'm not sure if I should do the conversion now with the exchange rate being above 19 Rand to the US dollar. At the same time, I'm nervous that it can get worse. How should I approach this decision? I mean, the Rand weak at the moment, maybe they're thinking it could get worse. How do they balance it out in terms of taking their money offshore?
I mean, it's a great question. I think it's sitting on a lot of people's minds now. And the one thing for me is when I don't know what to do, I always try and hedge my bets. And so in the investing world, hedging your bets, the best way and the safest way to do that is to make that decision in batches over time. In other words, if you've got money to send overseas and you're not sure that the rand's going to get worse or it's going to get stronger, why not take that money divided? If it's a lot of money, I mean, I think they say some cash. So, but let's just give two scenarios. If it's a lot of money, take it and divide it into 6 equal batches. And convert your rands into dollars once a month, do 6 monthly amounts over that time, for that whole lump sum. So, if you've got a chunk, then just break it up into 6 and send it. If you don't have a big sum, and maybe it's a smaller sum, because you've got to be careful of transaction costs. So you always want to make sure you do this as cost effectively as possible. So a smaller amount, then do it in 3 batches, and do one now, wait 2 months, do another batch, wait another 2 months, and you do the last batch. So you're still doing it over 6 months, but you're not doing one batch a month. You're doing it every second month. And the reason why I say 6 months is we don't know what the rand's going to do. My kind of, history tells me that the rand swings like a huge pendulum. It breaks out and it blows up and it's the end of the world and everyone's devastated. And then, we wake up one day and we realize the rand's not so weak anymore. In fact, it's quite strong. And I suspect we're in one of those cycles now where it's far too weak and somewhere along the line, it'll be stronger again. And I don't want to wait for that. I don't want to make a market timing decision. So when I don't know what to do, I spread out that decision over time. And then at least maybe I'm buying it 19 Rand today. If it weakens, I might be buying it at 21 Rand, in 2 months time, or I might be buying it at 17 Rand in 2 months time. Who knows? But spread it out and you hedge your bets and hopefully you sleep at night and stick to your decision making.
The misconception sometimes, Warren, is that going offshore will always mean you'll have good results. What should we look out for when going offshore? Because a lot of markets are going through their own turbulence that is sometimes even worse than what we're going through.
Exactly right. And you just look at, if I look at the UK, for example, they've got, they always have to give it a different name, so we've got an inflation crisis. Theirs is a cost of living crisis. Exactly what we've got. Their nurses are striking and their, railway workers are striking. And they're not used to their food going up, doubling every 2 or 3 years. We've got fortitude in South Africa. We're resilient. We know about this stuff. But the issue is, when you don't know, rather spread out. So take some money, make sure you've got some money in SA, then make sure you've got some money spread across the globe. Because what we do know is all these countries that have got problems, and there are real problems, they are not permanent problems, and especially not to the shares of their stock markets. So let's just take a company that's operating in the UK. It might be listed on the London Stock Exchange, but it might not be only operating in the UK. It might be a global business that happens to be listed in London. The same would apply to the US and Europe, and all of those economies are going through a tough time. But when interest rates start coming down because inflation's coming down, those economies start to recover, and by then the shares on those stock exchanges in those countries will have already recovered. The same will apply here. So spread your bets across many different countries. Make sure you've got good diversification. Stay with a large allocation to shares, and you won't regret the decision in 5 years. You might regret it tomorrow or the day after because that's volatility, but not in 5 years from now.
All right, that was Warren Ingram just taking us through our paces today in our personal finance feature, talking about all of us really being on a roller coaster in terms of investments well around the world, and what you should do as that roller coaster just meanders through the rough tracks. I mean, we've seen the market go down, and a lot of people feeling that they're losing a lot of money. They should be jumping off the roller coaster right now. He's saying stay put and make sure you sit on your hands and go through the tough bits so that the market returns to the green. You are part of those wins. I thank you very much, Warren Ingram, the co-founder of Galileo Capital.